With rising rates and investors playing defense. Yes, that crucial element that was missing from the New York Giants' loss. The defensive sector is taking off today as tech gets slammed. Rate-sensitive sectors, which would typically sell off in a high-interest rate environment like real estate, consumer staples, utilities, they all caught a bid, up about 1% or more, leading the market. So what is this move to defense saying about the market? Should investors out there follow suit? Guy, what do you say?
What does it say about the market? I think people are concerned. The VIX says people are concerned. And I think what the market is saying, maybe the Federal Reserve, who's about face, changing course, maybe it is going to have market ramifications. And maybe they are behind the curve. And maybe it's not going to be as easy as the market thought it was 6 months ago. I'll say this, though. I can't believe the market's piling into utilities. The XLU continues to go higher. It doesn't make any sense to me. But I do think there are places you can be. And I looked at two spots. I still think you can be in energy. And again, kudos to Tim on this, who's been on that for a long time. And healthcare continues to have this stealth rally that people don't want to talk about. But if you look at the big cap pharma names, they all traded really well on what was a pretty lousy tape most of the day today.
It's a bad sign for the markets that people wanted to go into these typically rate-sensitive areas?
I don't really think so. I mean, you think about it, the S&P 500 is almost up 8% on the year. So we're talking about we've had some sort of sell-off. It's down about 2.5% from the all-time highs it just made last month. So when I think about where people are focused on the equity markets and what's coming out of it, right now we're seeing high valuation. We're seeing very crowded trades. Like the MAGA trade is having a little hard time here. The Microsoft, the Apple, the Google, and the Amazon. And then if you want to go over to some of the, the kind of high flyers that don't have the valuation support as those names, stuff in the cloud space. We're seeing things like Adobe and Workday and ServiceNow. Some of those things have a hard time. So to me, I think it's really a little kind of rotation out of some of the very crowded, high valuation names.
And that's the thing for market players right now. Is there something different now? Obviously, the vol spike is something we haven't seen in 3 months. We're at 3-month highs. You can make an argument that between the tariffs, between the Fed, and maybe, whatever else you want to play in terms of where corporations are starting to make some noise about the fourth quarter, stronger dollar. But we've seen this before. And I agree with Dan in that a lot of this, to me, could just be rotation. How many times have we done this? I do think that defensively, there are names in the value camp, and whether it's energy, and I ultimately think that there still is a lot of value in the energy space. That isn't necessarily defensive if you start to worry about where there have been a lot of volatility in the past. Ultimately, I think banks are the place to play, and I still think you want to stay your energy.
I mean, the one thing is that this is not new, right? So staples bottomed in April, May, then healthcare bottomed in June. We've had a rotation that's been going on. Tech's relative performance, the leading sector, the largest sector, peaked on the 6th of June. This has been going on for weeks. This is just more of the same. There's no new rotation. This is a continuation of what's been going on for essentially 3 to 4 months.
But can the markets grind higher if this rotation is done, if the rotation that we've seen for the past couple months, if that is the rotation that will happen in the markets and we're not going to see the pickup in financials, or do you see some other leadership?
So if you think about it, we're losing the very strong, and it's not just tech. It's anything that was up on a rope, whether it's Visa or ISRG. Big super cap idiosyncratic growth names are rolling while money is coming into defensive names. It all depends, really, at least from my seat, on industrials and financials. It's not about the staples or utilities at the end of the day. That core middle would have to come to life in order for the market to go further.
We did see some signs of life in financials when you take a look at the intraday chart in today's session, at least. I mean, it reversed, right? Helped bring the markets practically to the flat line. Was that?
It's a good sign. I mean, but again, today's Columbus Day, so I don't necessarily, you don't want to, discount a little.
Is it still Columbus Day?
It's not.
I didn't think
Indigenous People Day. I don't think we're calling it Columbus, Mr.
I didn't mean.
Italian.
I'm sorry. I apologize. I didn't realize they made that change. So it was a holiday. So the bond market closed. So let's put it out there. But with that said, you have to be encouraged a little bit. Maybe the financials have put in a short-term bottom. I'm not so sure. I think Dan has said this before. The XLF is rolling over, and technically it sort of looks broken. If the banks are going to rally, they better do it soon. Otherwise, I don't know where we're going to get the leadership from.
Yeah, I'll just say that investors don't really seem that excited about the quick rate rise that they've had here, for banks. And I just want to make one other point. Again, we're talking about the S&P up 7.5%, and we know the concentration of those mega cap techs. I couldn't think of anything healthier for the broad market. If you think we're finally going to make a breakout again of those prior highs and go forward into the new year, would be a correction for the FANG, the MAGA, whatever you want to call it, right? So maybe something like a 10, 15%. Some of them are already correcting to that sort of point.
FANG plus index is already in correction territory.
So I guess my point is, if the broad market can hold in and you have these other sectors, whether they be defensive or not, those are not going to be the leadership that actually make a meaningful breakout ultimately.
Right, and to have lost sort of small cap growth was perhaps the best of all. And for have that to come off the way it has, it all is a little dodgy, right? We need it to stop. And as of now, it's not stopping.
Well, I want to highlight what Carter said about small caps. First of all, they've underperformed the S&P by about 8.5% since June. This is supposedly where the growth is. It's supposed to be the insulated U.S. story, and they're down 7% straight to the 200-day, which it's only fought the 200-day 4 times in the last 2 years. So this is a very significant level, and I would argue that this is the barometer of a market that's starting to turn. So I think you should be watching that break.
Is tech dead? I mean, we've seen it down, 4% over the past week or so?
I mean, if you take semis as the leading edge of tech, the beta within tech, the investment cycle within tech, it would suggest that tech is dead.
Ooh, it would suggest that tech is dead.
And,
what do you say?
we had, at a certain point, they're going to be stocks that are interesting on a valuation basis, without question. But
as a sector, because a lot of people are investing in the Qs, right? And not.
Yeah, I think right now there's going to be more pain ahead in terms of, especially semis, but in terms of tech broadly. But I'll say this, and Carter was here on Friday. We talked about, but I actually asked Carter a question when we was at the Smart Board. I said, are we going to start talking about a potential double top in the S&P? And he said, funny you should say that. And you know what? It's setting up that way. The S&P closed flat today, but technicians will start talking about a double top.
Yeah, funny you should say that also, though, but it's a really treacherous setup, right? So the worse these stocks act into earnings that get started in the next week or so is the likely muted, downside risk, is in my opinion, right? So I couldn't, back in January, when the market was up 8% as we head into earnings season or something like that.
It's a good setup for earnings this time around.
It's a much better, yes. A lot of these things are getting de-risked into the events.
That's a good point.
It's a good point. I think it's crazy to say tech is dead. And I know, you're asking the question, you weren't saying it. But ultimately, we've had a pullback of essentially 3% in the last couple of days, or over the last week. It's been trading choppy. We've seen this so many times, and the fact of the matter is, tech has gotten so frothy. I think you have to be careful about it.